Welcome back. Two more big Canadian banks reported earnings early this morning. Royal Bank of Canada beat earnings expectations and boosted its dividend by 4%. National Bank of Canada also reported better than expected profit and boosted its dividend as well. Both stocks have been star performers this year on the Toronto Stock Exchange. To talk about it further, let's bring in Dan Rohinton. He's a portfolio manager with IA Global Asset Management. Dan, thanks a lot for coming in.
Thanks for having me.
Let me quickly give viewers a snapshot first of the Royal results, and then we'll get Dan's view. Here's a look at the earnings per share. Royal reporting $3.07 in earnings per share. That's 4 cents more than the $3.03 that was expected. These are year-end results, of course. Royal reporting a 2024 adjusted aggregate profit of $17.4 billion. That was up 10% from the earlier fiscal year. In the quarter, profit came in at over $4 billion, and profit in its core personal banking segment in the quarter reached $1.6 billion. That was up 16% from a year ago. It was helped by the acquisition of HSBC Canada. Dan, what do you see in these numbers?
I see a travel and arrive situation where we have had a very strong result for Royal throughout the year. The execution on the HSBC transaction tells you that in-market deals, when they're done in Canada, can be done well, effectively, and generally speaking, on track with room for further upside. So we're at the stage now where Royal, the question we really have to ask ourselves is, what's the terminal multiple we want to pay for a company like this?
Right.
So travel and arrive, because great results, great momentum, but you're trading at almost 13 times forward earnings. And generally speaking, banks, the rule of thumb I like to say is buy them at 8 or 9 and sell them at 15.
You like the HSBC acquisition, and you like the way that Royal has integrated and executed on that deal.
Yeah, it's done well. And across the board, I think it's also worth saying that they're to the point where they can start thinking about future acquisitions or buybacks, because the capital ratios are robust as well. So we're big fans of what they did, and it was the last major Canadian bank transaction that can be done. And obviously, National Bank's the other one, where they're scooping up CWB.
A lot of interest in the U.S. market, and Royal is one of those banks that's active in the U.S. It has a high net worth business in California, among other things. How do you think the bank's doing in the U.S.?
Poorly. But that's the good news is RBC is primarily a Canadian-focused entity with wealth management and asset management footprints around other parts of the world. Think of Blue Bay in the UK, and think of the wealth management business there. What you described was City National, and that's actually been the sore spot over the last year for RBC, because they're facing funding pressures. And think of it as a First Republic light type of problem that they're seeing. But the best part about RBC is it's only a small fraction of their earnings and not a material component of them.
So I'm hearing you say that you would not add to a position in Royal right now because of the multiple. What would it take for you to become a buyer again of these shares?
I think it's worth saying we're happy shareholders right now, but I would say wait for a slightly better entry point to further add to the position. So this should be your go-to source as a Canadian bank investor to buy more. So before you go to BMO, before you go to CIBC, before you go to any of the others, dollar cost average into Royal. And that's our mentality.
Okay. National Bank of Canada, the number 6 bank in Canada with a big footprint, obviously, in the Quebec market. And that's been an asset, that's been a benefit over the years. There have been times when the Quebec economy has outperformed other regional economies in the country. But as you've noted, and as we know, it's now in the process of buying Canadian Western Bank, which will make National a very different institution. First of all, there are the numbers at National, a very narrow earnings beat at National by 1 penny. What are your thoughts on these results? And we'll talk about the CWB acquisition a little later.
Yeah, National overall, the benefit of what you described is their footprint in Quebec. Quebec has been the least sensitive to the housing growth and the boom that we've seen in other parts of the market. So it creates for a far more stable footprint. And also what's unique about National relative to some of the other bigger peers is it's very Canada-centric, outside of Cambodia, which was ironically a bit of a problem spot here this quarter.
That's a small business.
That's a small business, but the NPL formation was pretty material there this quarter.
Is that right?
Yeah. But at a high level, National Bank is heavy on Canada, heavy on Quebec, and heavy on capital markets. And those are higher ROE, more capital-light businesses, or sorry, the capital markets business that is, which gives them more flexibility to make decisions to take advantage of any issues or any opportunities that may come up, and CWB is an example of that.
And when National announced its plan to buy CWB, we can bring back the one-year National stock graph. The market didn't like it very much. The stock plunged by significantly. You see it very graphically there in early June. And then you see very graphically as well what's happened to the stock since that sell-off. Basically, the stock was put on sale. Do you like the CWB acquisition for National?
I think they paid a little bit too much than I would like, but to be fair, we were also participants when they raised equity at that drawdown. So we were buyers and we entered our national bank position when they did the acquisition of CWB, but we don't own it because we're so excited about CWB and the synergies. I think they'll come through. I think there's some reasonable wins that can be had, and it diversifies their footprint, which makes sense at this point in the cycle for them. But we bought it because it's domestic focused. We bought it because the ROEs are high. And generally speaking, outside of Credigy and ABA Bank, it is a pure play Canada footprint. And that's where you want to be in Canadian banks.
Okay. Have any themes emerged thus far? We've had three. We're halfway through the season now. Have any themes emerged, or are we looking at bank-specific stories across the three so far?
I think it's a bit of a yawner of a quarter so far. But I would point to the fact that gross impaired loan formation is modestly ticking up. And it's just something to keep an eye out, because you see top line growth that is starting to slow down, naturally so, because asset yields and funding costs are no longer the wedge that they were before, especially on the commercial books. And the US footprint is holding in. But gross impaired loan formation, which is ultimately followed up by provisions for credit losses and migration, is the main thing to watch out for. And we didn't get a decisive answer this quarter, but directionally it's still heading incrementally in the wrong direction.